Earlier in this course, we explored the fundamentals of investing and highlighted that there's a clear difference between investing and gambling. When we invest properly, we are dividing our money between dozens, hundreds, or even thousands of different companies from all over the world. Although nothing is guaranteed, when we invest properly, we can have a high degree of certainty that our investments will increase in value over the long term. Even if we are investing properly, we can't eliminate volatility from our portfolios. Volatility is the natural ups and downs that markets experience. This cyclical motion is due to the fact that markets follow the economic cycle. Just like anything else, nothing consistently progresses exactly at its long-term average. Everything is consistently either over or underperforming its long-term average. If we once again imagine someone playing with a yo-yo while going up an escalator, with the yo-yo representing the market, we see and experience the short-term ups and downs. But when we zoom out to take in the entire escalator, we see the yo-yo, or the market, going higher and higher over time. Our ride is never completely smooth as investors, but that's how we earn our reward. The volatility we experience is the price we pay for admission. We're constantly exposed to market risk, or systematic risk, something that we can never completely eliminate. On a day-to-day, it's the volatility that we experience. We can lower our overall portfolio risk by properly investing and diversifying. The more diversified our investments are, the safer we are. If our portfolios are concentrated to a specific company, industry, or country, our fate can too heavily depend on it, and we start to move away from the idea of investing and towards the idea of gambling. If investing is when we are systematically putting money into assets that we can reasonably expect to increase in value over a long period of time, gambling is placing big bets on hopes and desires rather than historical proof. If our outcome is tied to what we want to happen rather than what's reasonable to expect to happen, then we are taking on unnecessary risk and gambling rather than investing. It's easy to convince or trick ourselves that we are still investing and doing the right things, but if we look at it closely, it's easy to see the truth. Gambling can make us feel like we're close to reaching our goals because we're just a little bit of luck away from making them a reality. But the good luck we need is anything but certain, and in most cases, it's nearly impossible. We also tend to ignore the negative potential gambling has. We only focus on what we want to happen, not everything that could happen. What's more likely to happen is that we get bad luck, and any progress we made towards our goals gets completely wiped out. This could put us back years, decades, or even make goals that were probable become impossible. If you're worried about the possibility of losing all of your money and you're gambling, then it's a rational concern. We know that the house always wins. But if you're investing properly and worried about losing all of your money, it's irrational. That's because we invest in governments and companies that make up our world. A world where a properly diversified portfolio drops to zero is one where every government and company has failed. This would mean that no one has a job and money has no value. It would be a world where we have far bigger concerns, and one that seems anything but possible, no matter how grim things feel. Throughout history, there's always been countless reasons to feel pessimistic about the future, and yet things continue getting better and better. Viewing properly investing as a way to lose our money is anything but reality. When we look at long-term historical data, the longer we invest, the better our results become. Investing isn't a way to lose our money, it's the best way to grow it. By understanding how investing works, we can have more realistic expectations for what might happen, and more accurately assign risk. When assigning a risk level to something, we have to understand two main metrics: its probability and its consequence. When considering gambling, there's a high probability that things won't go in your favor, and if they don't, we're likely looking at a significant loss. Investing carries little risk when done properly, and the consequences are low because in the event where something goes totally wrong, everyone else will be in the same boat. Although investing is often seen as a risky activity, it can actually reduce risk in our overall financial picture. Year after year, inflation leads to the increase in the cost of goods and services. We should expect prices to continue to rise in the future. The further away our time horizon is, the more we should expect prices to increase by. If inflation is steady at 3% per year, the Rule of 72 suggests that the cost of something should double every 24 years. If we aren't investing and at least growing our money with the rate of inflation, we're actually losing buying power. As inflation increases the cost of things around us, we'll be able to buy less and less than the year before. Our default often makes us view investing as risky and not investing as safe, but it's more so the other way around. Properly investing puts our money in a position where it can do two really important things. It can grow to keep up with inflation so we aren't losing buying power, and it can grow above and beyond inflation to build us wealth. This actually lowers the overall risk on our financial situations. By growing our money, we can avoid inflation risk, aka the silent wealth killer. And by allowing our money to build wealth, we can make our goals and what matters most more probable to happen. This creates less dependency on our income because instead of having to continue to work for it, we can allow our money to work for us. When assessing our own risk profile, we need to consider two important factors: our risk tolerance and our risk capacity. From previous chapters and lessons, we've learned about how often and to what degree markets move. Here's the visual again, and we can see the more aggressive the portfolio, the higher the highs and the lower the lows. If you had a portfolio worth $1 million, historical performance could have seen it drop as much as 43.1% or over $430,000. Even though it's normal volatility and can be seen as a temporary drop rather than a total loss, it's still an amount of money that would make my stomach turn. If our goal is to invest for as long as possible, we need to invest in a way that encourages our continued success, and not in a way that ends up being too stressful to tolerate. This is going to be different for everyone. There's no one-size-fits-all solution, but our personal risk tolerance is going to depend on our personality, investing experience, and financial situation. Our risk capacity is something that's often overlooked and takes precedence over our risk tolerance. If this is what we can expect our portfolio to look like over a long period of time, and the orange circle represents when we expect to need funds for our goal, we want to narrow our possible outcomes. As our goal approaches, we can reduce our risk tolerance to a level that prioritizes the funds being there when we need them over growth. We don't want to risk the market being significantly down when we reach our goals, leaving us short of what we need when it counts. We need to put our personal risk tolerance aside and implement a strategy that best serves the goal we are working towards. In many cases, this will look like approaching our goal in a much more conservative portfolio than what's suitable for our long-term goals, where growth is our primary focus, like retirement. But it helps ensure that we arrive on time and as expected. If we have significantly more than we need for a goal, or our timeline can move depending on market conditions, then it becomes less important to move towards being the most conservative, but our mindset should still shift from growth to protection. Proper investing is all about expecting the unexpected. We can't know what will be the major things that impact our lives in the future, but we know there will be something. Carl Richards, of the Behavior Gap, defines risk as the following. Risk is what's left when you think you've thought of everything. When we understand how investing actually works, it allows us to better understand what risk is, and what risks we really have to account for. Investing properly has a low probability of a catastrophic result. Let's think about this in a more relatable way. More often than not, if someone has a pension, they believe they are set for retirement. They believe that it is safe, guaranteed, and they have nothing to worry about. A pension is simply investments through a company plan. The pension company is investing their funds in an appropriate way to provide their clients with a relative retirement income. A lot of people view pension plans as perfectly safe, but personal investments as completely risky. They are essentially the exact same thing. Contributions taken and invested towards your goals. And it isn't like pensions have completely unique investment options. Pensions are invested in the same way the rest of the world invests. As investors, we can't know what will move the needle the most in the future. So what we want to do is put ourselves in the best position possible. One where, regardless of what happens, we'll be in an optimal position. That's how we best manage risk. Not by knowing exactly what will happen, but by being in a position to weather any storm that comes our way. With all of that said, I believe that there are three main ways that we can go about managing risk as investors. The first way is the approach we take with our investments. The second way is what safeguards we create around us. And the third is how we behave along the way. In this chapter, we're going to explore all three, starting with the very next lesson.